This video is going to be all about me. I'm only kidding. But basically this video is going to be a lot different to anything that we do on this channel. Normally we sort of have scripted, very formatted videos, but I just want to have almost a bit of a casual chat talking about my own sort of personal finance journey, what my sort of long-term investing goals are, and how I deal with my own financial planning. So I'm making the video because ultimately, whether we like it or not, financial planning is very important, and it has at least some relevance to almost every aspect of our lives. So basically, I just want to talk about some of my own thoughts on financial planning, some of the decisions that I've made and why I've made them, and then hopefully you could sort of use those thought processes to, apply them to your own situation, and hopefully think about some things that you've maybe never thought about before, and it could improve your own personal finance situation. That said, it's important to know that at iQinvesting, me or my brother, we are not chartered financial planners. If you do want advice, then you should seek that from a professional, and you could get tailored advice to your own personal circumstances, because ultimately what works for me or what I think works for me is not going to necessarily work for you, because your situation could be a lot more different to mine. So to help you understand how my situation actually is, I'll start by giving a short background on myself, where I'm at with my sort of personal finance journey. I'll then also talk about some of my investing goals, how that sort of relates to the portfolio that I have now. I'll then sort of talk about how my portfolio may change over time. I'll then make sure to talk about my pension and some of the considerations around that, and then generally just some of the other considerations, especially for sort of longer term financial planning. And I'll also give my thoughts on would I ever want a financial advisor. So starting off with a quick background on myself and my current situation. I recently graduated from university, that was last summer, and then I got my first job in September. You definitely could say that I had a good time at university. I wouldn't trade those years for anything, but during that time period, I wasn't as interested in personal finance or investing as much as I am now. So I had no money saved up, actually. I spent a lot of time in my student overdraft. Hands up, I could have done a much better job, but it is what it is. So then when I finally started earning in September, I started on a salaried income. I figured out it was, time to change my ways and start taking personal finance a bit more seriously. So when I did actually start working in September, you could basically say that I started from scratch. I had a few expenses that I had to make. I had to purchase a car so that I could commute to work. I also spent quite a bit of money on equipment because I was just starting a YouTube channel. So I sort of saw that as a bit of an investment because I understood that over a longer period of time, it was something that I was going to commit to, and I could definitely see a return on that. But ultimately, as I've said, I was starting from scratch, so I had to start saving money, and I guess that's where my sort of financial journey started. So at the beginning, I spent a few months sort of saving money and building my emergency fund, because as I've spoke about in previous videos, the importance of emergency fund, I don't think you can really put a price on it. It essentially just means saving up enough money so that should anything bad happen, I was to lose a job or whatever, I could then survive on my money for 3 or 4 months. So that took a while to do, of course. I had a few expenses. I had to buy a car, some equipment, Christmas, things come up. So I had to, save as much money as I could. And then after that, that's when I could properly start investing. So when I did start investing, I had transferred my stocks and shares ISA over to Vanguard. I previously had trading 212, but that was never anything serious. And I realized that I was going to be doing long-term investing with index funds or ETFs on Vanguard's platform. So that's what I got set up for. So without going into too much details about the Vanguard account and what I have so far, it's important to sort of first mention my investing goals. So speaking of investing goals, I've sort of got 2 distinct categories that I like to break it down into, and I'd call that short-term investing goals and then long-term investing goals. So starting off with short-term investing goals, there's sort of one main thing which I'd like to achieve within maybe the next 5 years, which would be to purchase my own home. So with something like that, I know that I've got around 5 years to save and invest towards that. So I'll talk about later how I sort of integrate that into my investing portfolio and how I make decisions towards working towards that goal. And then there is the long-term investing goal, which admittedly I've not defined very well, but ultimately I just want to have as much money saved up for retirement as possible. And when I say retirement, I ultimately mean achieving financial independence. I wouldn't quite go as far to say that it's part of a FIRE movement, which is financially independent, retire early, but I definitely do want to achieve financial independence generally as soon as possible. You know, I'm not going to live an extremely frugal life, but I am a generally frugal person. Generally want to spend as little as I can, save as much as I can, so then I can have financial independence, which will allow me, when I retire, essentially, to spend my time how I'd like to. I'd not necessarily stop working, but just knowing that I'd have the comfort of being able to live off my own investments, that's something that I value a lot. So yeah, I don't actually have a set value of what I want to work towards, but of course, you know, as much money as possible would be nice. So as I mentioned earlier, I am very much at the beginning of my sort of financial journey. I've only recently built up an emergency fund and only been investing for a few months. So ultimately, how I do that is through my salaried income. Of course, I get paid every month. So I have a set budget. I know roughly how much I spend each month. Of course, it can vary depending on unexpected expenses and such, but I have a set amount that I invest into Vanguard each month, generally when I get paid. And then generally, if there is any spare money that I do have left over, then I try to put as much of that into Vanguard as possible. So speaking of Vanguard, of course, I have to choose an index fund or ETF that I want to invest in. And as I've mentioned in previous videos, I am 100% invested in the FTSE Global All Cap Index Fund. So first, I'll sort of speak about the fund itself and why I invest in it. So as you know, I generally love the index fund because it's got so many stocks, around 6,800. You get complete global diversification. It's generally quite a low cost at 0.23%, and all of the investments are literally in one fund. So when I'm paying my money into Vanguard each month, I just have to put it into that one index fund, and that's it. It's sorted. I don't have to do anything else. I don't have to think about balancing my portfolio. I don't have to think about what percentage goes into anything. It's just all sorted. Now, admittedly, there are a sort of other combinations of funds that I could use. You know, we've talked before about a free fund portfolio where you use the developed world excluding UK, the emerging markets fund, and the FTSE UK all share index unit trust, and you essentially get a replication of a FTSE Global All Cap Index fund for a lower cost. So you could think, why would I not do that? And, you know, essentially my answer to that is, even though I love investing, you know, I almost spend every day reading about or making videos on it, I really do just value the simplicity that the FTSE Global All Cap Fund offers. Whilst it's not necessarily the cheapest option, even I, who sort of loves investing, I don't really want to spend my time thinking about what allocation needs to go to each fund, because ultimately I would probably start tinkering with it. I'm sure I try to optimize it in some way. So to just stop me thinking about that, I just invest all of my money into the FTSE Global All Cap Index Fund. So this fund is essentially my investment vehicle that I use for my long-term investment goals. So all of my investing goes into the stocks and shares ISA with Vanguard. If you don't know what stocks and shares ISA is, it's essentially a tax wrapper where you can invest your money. You get up to £20,000 allowance each year. And, you know, you don't have to pay tax on any dividends or capital gains. Of course, you may be thinking, how do I go about saving for a house? Because that's only 5 years away. So being invested in 100% equities, that may be a bit too risky, because what if there's a market crash within the next few years? If there's a bear market, my savings for a house could plummet. But I'll basically explain how I do that later. So even though I invest in the FTSE Global All Cap Index Fund, I am aware that it's not necessarily the fund that I'm going to stick with all of my life. And the main reason for that is that essentially I want to move into factor investing eventually. So if you don't know what factor investing is, we've got a video on it. I'll make sure to link it above. But also there's a video from Felix, which I'll definitely pop in there because he'll explain it much better than I ever would. But basically, a quick description of that: you can target in risk factors in investing, such as value stocks, small companies, profitable companies, companies that don't invest too much. And essentially, you can get higher expected returns by investing in these companies because they generally carry higher risk. So the next question sort of would be, why don't I invest in factors right now? And ultimately, I don't think there's any great options, or at least not any that I've found personally, for investing in factors in the UK at the moment. Vanguard recently closed their factor investing funds, and I do know that iShares have some options, but it's something that I need to look into in a bit more detail. I've looked at them briefly, but I'm not quite sure how I'd balance them and make a portfolio that sort of is factor tilted in the best way. So it's something that I'll definitely research over the next few years, and maybe over time I'd start to move my portfolio in that direction. And, you know, I definitely update you guys when I do that. So that's a bit of an explanation of my portfolio so far. So as I mentioned, I'm 100% equities. You know, I've got a long investment horizon. I've got generally quite a good tolerance to risk. I literally don't look at what the markets do. you know, I've got friends who sometimes mention, oh, have you seen what's happened in the markets this week? And I'm just absolutely switched off to it, because I know that over the next 40 years, the markets are generally going to go up. So what happens today, next week, next month, it literally doesn't matter to me. So, you know, I'm just going to keep on pumping my money in there and getting those sort of long-term gains. So then I guess it makes sense to transition into my short-term goals, which would be saving for the house. So, you know, this is something that I want to achieve within the next 5 years. So the sort of investment vehicle that I choose to do that is through using a LISA, which is a lifetime ISA. So if you don't know what that is, essentially it's a savings account where you can save up to £4,000 each tax year. And for every pound that you put in, essentially, the government top you up by 25%. So if you put £1,000 in, the government are going to give you an extra 250 quid. If you put £4,000 in, which is the maximum for each year, you're going to get an extra £1,000. So ultimately, you know, it's a great investment. Like, there's not many other investments where you could just get a guaranteed 25% bonus. The only sort of downsides for a LISA is that you can only withdraw the funds if using it to purchase your first home, or if using it for retirement. So as I've mentioned, I'd be wanting to purchase my first home, so I'd be able to get that money out hopefully within 5 years when I go to do that. It's worth mentioning that since I'm only 23, it wouldn't really make sense to save in a LISA for retirement, because, you know, over the next sort of 30, 40 years, ultimately I'm hoping that the stock market would grow by more than 25%, which is the sort of guaranteed return from a LISA. But ultimately your cash is then just going to be sat in the account. So I think it's good for sort of short-term gains or short-term boosts, such as, you know, going for your first home. But saving for a longer period of time, that's something that I'd much prefer to use the stock market for. And, you know, that's why I'm investing with Vanguard. So essentially, that's how my portfolio is balanced, how I like to think of it. Although I'm 100% equities on one side, I'm also saving some money into a cash LISA, which is, you know, it's cash, it's safe, guaranteed return on investment. I'm not going to lose that money. There is the option to invest in a stocks and shares LISA, but again, for the reasons that I've just mentioned, I'm already 100% in equities on my one side of things for the long-term investing. The short-term side, I'd much rather just be safe, set money, and put that towards the house. So to sort of put some numbers towards a house, you know, it's very early stages. I'd have no idea what I'd be going for, but I'd assume a house in the range of £200,000 up to £300,000 maybe. So ultimately, saving on average towards a 10% deposit, I know that I'd have to save between £20,000 and £30,000. Now, hopefully, I'd be able to do that with my girlfriend. You know, she'd be able to chip in a bit. So then if we half that, we'd be looking in the range of £10,000 to £15,000 over the next 5 years. So I guess on average, you could say I need to save around £2,000 in a LISA. And of course, I'd be getting the government boost on top of that. So how would I go about investing in the LISA? Well, basically, you have to get the money just in there within the end of the tax year, which runs from April to April, and then you can get the boost. So how I'm going to play it this year, or how I plan to play it, is put as much money into the sort of stocks and shares ISA that I have with Vanguard as soon as possible, because as that's going to be invested, that'll give it more time to grow and compound over time. But then when I'm investing into the sort of cash LISA, I'm just going to essentially shove that in at the end of the year, because that money's not going to be compounding. It's not going to be growing. So it makes sense to squeeze that in at the end of the year, so to speak, whilst putting as much money into the stock market as early as possible, so that that has more time to grow. So yeah, there's not a massive science behind it, but it's just maybe a consideration that you could think about, and, you know, hopefully you could use it to benefit yourself too. So also, I sort of alluded to the fact that I'd be saving for a house with my girlfriend, which I guess brings us onto a quite an important topic related to financial planning, which I think is just generally just be open about it. You know, whether you're in a relationship or whether you're talking to your friends about it, it's going to benefit you if you talk to other people about your plan, about your strategy, just so that, you know, you can get a second opinion. You know, I think if people are just more open about money, you know, it's not going to be a bad thing. You know, I'm completely being open to you about my investment plan. I don't have to tell you exactly how much money I've got. I've not told you what's in my portfolio. But if I talk through my strategy, it just gives me an idea to think over it myself. You get other people's opinions. Hopefully you'll tell me your opinions in the comments. Just try not to slaughter me too much. But yeah, with financial planning being such a big part of our lives, and, you know, a big part of a relationship, if you want to look at it like that, just be open about it. Like I said, just talk to people about it. Be open about your plan. And, you know, it's only going to improve your financial plan through doing that. So we've essentially gone through how I invest in my stocks and shares ISA with Vanguard. I've talked about how I use a cash LISA, which I should probably mention I use it with Moneybox, because at the time when I opened my LISA, they were offering the best interest rates on money. That may be different now, so look into it yourself. Generally, there's some good comparison websites, and some of them will offer good interest rates. When you open accounts, you maybe could get 1 or 2%, which in today's environment is pretty good. So the next sort of consideration when it comes to financial planning is my actual pension. So, pensions are a huge part of investing. Ultimately, it's coming directly from your salary. Most people don't realize, but it's probably the most money you may even save towards retirement. So it's definitely important to be on top of your pension, know where your money is invested, and generally actually choose the funds that are inside your pension. So I'll go into a bit of details on that. So I am early on in my career. I've only had 2 jobs over my entire life. So I had a part-time job with Asda, actually, back in the day, stacking shelves. So this was a part-time job at university. But during that time, I did actually, towards the end, I got auto-enrolled onto the pension scheme and essentially started paying some money into that. So I had a small amount of money in there, and now obviously I work for my current job and I pay a pension into that. So I'll focus on my current pension so far. So I think one thing that many people overlook is actually looking at your pension. You can literally just log into the provider. So my current pension provider is with Scottish Widows. So recently I got the sort of welcome starter pack. I log in, registered my accounts. It shows you what fund your money is automatically invested in, but generally it's not that the funds are bad, but they might not match your risk profile or generally what you want to invest in. And that was definitely the case for me. So I was able to choose a pension fund. I found an international equity tracker, probably somewhat similar to the FTSE Global All Cap Index Fund. It was just like the Scottish Widows equivalent, and that's where I've chosen to invest my money. Now, unfortunately, it does pain me to say that Scottish Widows, the fees are just appalling, to be fair. The platform fee, I think, is 0.69%, and all of the pension funds have a annual ongoing charge of 1%. So I think I'm paying a total of 1.69%, which really hurts my heart and makes me want to cry every night before I go to sleep. But unfortunately, there's nothing I can really do about it. It's worth explaining that the reason I can't do anything about it is because it's a workplace pension. So it's work who've set up the pension with Scottish Widows. And so when I pay into my pension, it automatically goes through work and it's invested with Scottish Widows. It's worth mentioning that my employer currently matches my contributions. I think they match it up to 3%. It's worth checking with your own employer how much they'll match your contributions. So by this, it means if I'm going to put in £50 each month, the employer would also contribute £50. So this is literally a guaranteed 100% return on investment. Ultimately, if you can afford it, you should try to maximize your employer contribution as much as possible. Some employers could even go up to 4, 5, 6%. It depends. It's worth asking because, as I mentioned, it's literally doubling your money that's going into your pension fund. So that's a quick overview of my current pension with Scottish Widows. So again, I've chosen to invest that in a 100% equity index fund. I'm going to be investing into my pension for over 30 years. So there's no reasons why I'd need to hold bonds in my pension, in my opinion. I may change that over time, but again, I'll go into some details on moving into bonds in a moment. So next, we'll move on to my old pension. So as I've said, for a very short period of time, I was paying into a pension with Asda. I think I had Legal and General as my pension provider. I never actually logged in to check the fees or even what fund I was invested in at that time, but I would assume that it's probably a similar situation to Scottish Widows, high fees, probably not a fund that really matches what I want to be investing in. But once I did finish that pension, they send you a letter and they say, what do you want to do? Essentially, do you want to keep your funds with Legal and General? Do you want to keep paying into it, or do you want to transfer out? So recently I actually dug up that letter literally last month, and I realised, look, I'm probably going to be paying super high fees at Legal and General. I could just transfer that over to Vanguard. So what I chose to do was open a SIP with Vanguard, which is a self-invested personal pension. And essentially it's just another type of pension account. So all I had to do was, get the transfer document, put in some details, and all of my money was transferred over to Vanguard into a personal pension. I could invest in that pension if I wanted to, tax-free, but it doesn't really make sense because, I don't get any employer match contributions. But at least all of my investments are now with Vanguard. I've also chosen to invest that in the FTSE Global All Cap Index Fund. I've got the low Vanguard fees, 0.15% platform fee plus the 0.23% for a FTSE Global All Cap Index fund. So I'm probably saving a lot more money. I have a bit more control of my investments because, I use Vanguard quite frequently, so I can log in and monitor that. So essentially, every time I do move employer, if I move from a pension scheme such as the Scottish Widows that I'm with now, I'm going to then consolidate that into Vanguard. So I'm going to move all of my pension funds towards Vanguard because, as I've said, I'm paying 1.69% at Scottish Widows into a fund that, it's a good fund, but I prefer the FTSE Global All Cap Index fund, and plus it's like 1/5 of the price. So it just makes sense to move all my pensions into one place, get them cheap, and I can invest in a fund that I know is good, essentially. So I mentioned earlier that I might eventually want to change how I'm investing my money. Maybe I want to move away from 100% equities because generally, as you approach retirement, bonds start to make a lot more sense. Although they have lower returns, they're much less volatile, and they can just provide that bit of stability that you may need towards retirement. Now, of course, retirement is a long way away from me. It's going to be 30 to 40 years away. So it's not something that I put a lot of thought into right now. But there is actually a lot of research that shows, sort of contrary to popular opinion, that staying invested in 100% equities, even through retirement, could be optimal. Now, again, this isn't financial advice. This is just something that I've thought about, something I've heard on podcasts through financial advisors talking about it. And essentially, research has shown that the best results, even throughout retirement, could be to just stick with 100% equities. Because although you're going to be in a volatile portfolio, essentially, you're still going to spend around 20 years, hopefully, in retirement. So if you can stick that out and keep with 100% equities throughout the end, you can essentially keep hold of that good growth and just keep it going for longer. So that is something that I might consider. It's easy to say now as a young investor with, a load of human capital. I've got a load of time on my side. I'm probably going to think about it a lot more differently when I'm 60, and I want to keep my money secure. But it's just something that I thought about now. It doesn't hurt to think about it, but just something to keep in your back of your mind. So the last thing that I want to talk about to sort of round off this video, as we've been talking about a lot of financial planning topics, is would I get a financial advisor? Now, before, this would have been a sort of really easy question to ask. I'd have thought no, straight up no, because ultimately you look at the fees for a financial advisor. Sometimes you're going to be paying around 1%, 1.5% per year. And for me, that'd just be an instant no. That's too much money going out of a window. I feel like I have a good idea of investment strategies. I have a good idea of what I want to be doing with my money. So why pay that extra money when I feel like I can do it myself? But it is something that recently I've started to maybe understand the benefits of it a lot more. So a podcast that I do listen to, and I get a lot of ideas for this channel from, is the Rational Reminder podcast. It's by the same creators of the Common Sense Investing channel with Ben Felix. There's two financial advisors on there, Ben Felix and Cameron Passmore. And, they're really great guys. They've got a lot of great ideas. But they've also helped me understand the actual importance of having a financial advisor. And, it's essentially a lot deeper than I thought. At first, I thought, they're going to help you choose a portfolio. They'll maybe sell some products to you, and that's it. That's the only value you're getting. But there are other sources of value that you can get. So to mention a few of these, the first would be to help you set financial goals, which is admittedly something that I need help with, because as I've mentioned, my long-term investing goals, I've just said I want to be financially independent and I'd quite like a lot of money. But, they're definitely not, concrete goals. And, financial advisors are really good at helping lay them out and, maybe help you think about how the financial goals that you have can sort of integrate in how you want to live your life. Not only that, but they also allow you to, review your strategies every now and then. At least each year you're going to get a checkup, make sure that you're sort of on plan, make sure that you're saving enough, making sure that you're on track to actually achieving these goals. They can also help you with tax efficiencies, which again, at the moment, I feel like it's really easy for me to say, oh, well, tax efficiency is easy. I've just got to invest all my money into a stocks and shares ISA. But ultimately, I'm 23 years old. I've just started investing. I've barely got a net worth. But as I get older, hopefully start to get other sources of income, start to build that net worth. Ultimately, my portfolio and my sort of financial planning is just going to become much more complex. It's going to be harder to track. My sort of estate is going to grow, hopefully. So, having someone there to ensure that everything is being done optimally, you could literally get the value back that you're going to be paying for this added advice. And the final factor, which they emphasize a lot on the podcast, is the idea of behavioral checks. So it's good to just sort of have someone there to talk through your ideas with, ensure that you're not sort of developing any psychological biases, because ultimately it's really hard to notice when you're being swayed by subconscious things that are happening in your own head. So that is an overview of my investing strategy, and hopefully you've learned some ideas about financial planning that you've not necessarily heard before, or maybe it's helped you think about some of the own challenges in your own life. Now, ultimately, financial planning is complex. I've talked about some of the things here, but it is very situational. Every person is going to have different circumstances, and ultimately our lives and our financial lives are going to be dominated by unexpected events. And you never know what's going to happen. That said, I do think it's important to have quite a comprehensive financial plan, or to at least think about a financial sort of strategy moving forward. Maybe what are your goals? How are you going to work towards those goals? How your investments sort of reflect that, and ultimately try and piece it all together so that the end game is so that we can live the life that we want. So yes, whilst I spend a lot of time talking about the perfect portfolios, the cheapest funds, the best investing strategies, ultimately, it comes down to how we can use those strategies to facilitate the life that we want to live and live the best life that we can. So on that positive note, we'll leave it there. If you enjoyed the video, make sure to let us know in the comments. Smash the like button so that we know whether we should make more content like this. If you preferred structured videos, no problem. Literally just let us know. We're completely open and we just want to try a few more things on the channel. So yeah, hopefully you enjoyed it. Subscribe to the channel if you haven't already. And as always, thanks for watching.